Hello, everyone. Thank you for joining us today. We have some great ideas for you on how to stay ahead in insurance sales today. If you have any questions during the presentation, you can enter them into the chat or the Q&A panel, and we will read those off for you. I'll also be posting our panelists' contact information in the chat in case you'd like to follow up with them after the show. Without further ado, I'm going to turn it over to our MC, Mr. Tom Berkler.
Thank you, Lisa. Thank you. It's good to be back. We haven't had a CPS Live in quite a while. Lisa, who keeps her finger on the pulse of our clients' desires, has been bothering me for a couple months now. She said the demand for the return of CPS Live has been so great that we're forced by the opinion of those who do business with us to get this back on the track. And nobody's more delighted than me to announce that it's coming from our new Bowling Green, Kentucky studio here, at least from my end. All of this an attempt to increase CPS's footprint across the length and the breadth of the land. So it's from this new location. We don't have the lighting quite down like we would desire. I'm told by several people on the panel today the shirt doesn't quite make it, and also the lighting on this side. They look like who's the villain in Batman or Dick Tracy? He kind of has the
Two-Face?
half the. Who is it, Lisa?
Two-Face?
Two-Face? Yeah, yeah. And Tom Nichols said no problem. It'll just allow you to speak out of both sides of your mouth a little better. So Tom Nichols having complimented me in that way. I'm going to make you go first, our disability guru here, Tom. Tom, you and I talk a lot about in buy-sell planning. Of course, everybody perfunctorily with regard to insuring the agreement looks to life insurance. But the point you like to make is that disability of an owner employee can be just as crippling to a company as the death of an employee. And you like to use the statistic that in a three-partner firm, the likelihood that one's going to be disabled during their working life is 9 times the likelihood of one passing away. And of course, the big problem is that term life insurance is the typical solution. So sometimes there's a little bit of a sticker shock when we try to get them over to the disability side and get them to insure against disability. But so you're going to talk today a little bit about that, the disability buyout insurance that maybe economically, certainly this can be more practical, but maybe more palatable economically. So take us there, Tom Nichols.
Well, thank you, Tom. Yes, I think this is probably one that goes overlooked more than it should. And of course, me coming from the disability department, I always think disability gets overlooked probably more than it should. However, we sell a lot of term life insurance for buy-sell purposes. If you've got a partnership and somebody doesn't make it home from work one day, they get a lump sum payment, they can buy it out, it's seamless, but a disability it could be a little more disruptive because we never know the severity of an illness or an injury and how long it could last. But I see that most of these buy-sell agreements are set up to cover disability, that it's going to trigger a buyout after 12 months, but most of them aren't funded. And that's the crazy part. It's like, who's going to buy out these shares? When are they going to buy them out? And where's the money going to come from if somebody gets sick or hurt and they're out for a year and it triggers a sale of their share of the business? So we had a recent case where we had 3 partners and each of them had a $15 million stake in the business. And if one of them were to pass away prematurely, they had life insurance. It's quick, it's seamless, it's part of their agreement. They have to have the purchase those shares of the business within, I don't know, 90 days after the death. But they put a 12-month wait on the disability. So if somebody got sick or hurt, it gave them some time to recover. In other words, it wasn't going to just, okay, after 90 days, if you're sick or hurt, it's going to trigger your sale of the business. But after 12 months, it's going to trigger the sale. And then it would pay a lump sum, $15 million to the partners to be able to buy out those shares of the business. So we find that many of these companies who don't have a plan, where's the money going to come from? Are they prepared to take on $15 million of debt in the company in order to borrow those funds and pay off that family? Are they going to have to sell part of the business to pay off that debt to the survived or the disabled partner? So what we want to do is at least bring it to the table that we can do this affordably. And there's a couple of different strategies we can talk about. We could even push out that elimination period a little farther. We could go 2 years and then set up a disability policy that would pay the disabled partner an income for that 2 years. And then if after 2 years they're still sick or hurt, it reduces the premium by about 25% by pushing out that um, elimination period for 2 years and then buying a separate policy to pay the partner. But this one case where we had the $15 million for all three partners, that yielded a $27,000 premium. And Tom
Wow.
mentioned earlier, they get a little sticker shock, but we're using corporate dollars here to fund this. Okay. So it's, they're all putting in for this thing, and it's owned by the corporation. So they're able to fund it a little bit easier. And so, yeah, $27,000 case, just by making sure that if somebody gets sick or hurt, they're going to have the capital. They're not going to have to take the loans out. And they made a nice sale on top of that, just by bringing it to the table. So I guess the moral of the story is, don't let the disability buyout conversation go overlooked when you're doing your succession planning with your business partners. We've got carriers that'll issue all the way up to age 70, because you'll find a lot of these business owners are a little older, a little longer in the tooth. And so a lot of our domestic carriers might not issue those, but we do have Lloyd's of London that will take up to age 70. And we can go up to, I mean, the sky's the limit when it comes to value. They'll do up to 50 million per partner. So I'll hand it back to you, Tom, if you got any questions.
I had a question come up, Tom. We didn't talk about this before we went on the air, but when you've got an owner employee, there's actually two needs there. There's the disability need to buy him or her out, and then they've lost the services of that employee. What's the availability of additional disability coverage, key person disability? Does that increase what a carrier might give you?
Well, they would do up to 10 times their earnings, whatever their income was, much like a life insurance would. And I think it's a great idea. But also, is the corporation going to continue to pay this non-producing partner? The partner's been
Mhm.
out sick. For how long are they going to continue to pay them? Looking at a short-term disability policy to pay them during the waiting period of the buyout, because many people use the business. That's their retirement. That's the money that they're
Mhm.
going to take into their retirement year. So that $15 million was going to be used to do that. But he had to wait a year before they could trigger the sale of that business. So buying a policy that would pay that disabled partner as well as a key person, because they're going to lose bottom line. If the managing partner goes down, they're not going to be as productive. So there's several needs there, but depending on how deep their pockets are and what they're willing to pay, we can design a
Mhm.
plan that could meet those needs.
But the introduction of an additional need will increase the carrier's willingness as to the total amount of coverage that they'll give.
Yes.
Yeah, okay, good. Thank you, Tom. We got Matt Anderson over here. Matt, you and I, we've gone through a lot with LTC, and the one thing we discuss all the time is the big variable that makes people maybe a little leery sometimes with regard to LCTC coverage is, like every other product in the marketplace or every other need in our life, the risk of increasing premiums. And you want to come on today and talk about maybe a product or a situation where we can overcome that fear of premiums getting out of hand with an LTC program that is put in force by one of the clients. Help us out there, Matt.
Yeah, so it's often one of the biggest complaints I think about the long-term care space is that traditional LTC policies historically have been horrific with rate increases, right? You design the policy to have a premium, but fast forward 10, 15, 20 years, and then the carrier does a rate increase down the road, and that's always a problem. So what if we could imagine a world where the rates were guaranteed, and it really doesn't cost you that much as far as premium to get into something that's fully guaranteed rates. So I'm going to share my screen here and show you a couple of examples that I've been working on recently. So this first client, I've got a traditional Mutual of Omaha plan compared to actually a joint hybrid plan with Nationwide. This is for a employer group that were trying to implement a plan for 6 doctors and their spouses. So here we've got a couple age 54 and 60 years old. Give them a modest $4,000 benefit each day one, but I'm going to grow those benefits over time. The plans really mimic each other. If anything, the nationwide plan is a little bit more attractive as it's offering a 0-day elimination. It's got some cash value. It's actually got a backup death benefit in the event that they don't have a claim. And it's got fully guaranteed premiums that can never change, go up, or be altered. Plus, it's actually a pure cash indemnity plan. So premiums for something that's very similar to traditional LTC. In this case, annual premium on the traditional is $7,200. Annual premium on the nationwide is about $7,300. So basically, if the client is willing to pay an extra $70 a year, what would that actually purchase them? Well, in this case, they're going to have a larger overall benefit pool by the time we expect them to use their benefits. Call it an extra $100,000. They're going to also have a 0-day elimination for both home care and facility care. You're going to get cash value in case they want to surrender the policy, although no one does. They get that backup death benefit so that if they don't have a claim, the second to die, they're at least going to get $144,000. And cash indemnity with fully guaranteed premiums that can never be changed or altered. As far as a willingness to spend, an extra $70 a year to get all of those additional features, I think it totally makes sense, even though I personally think Mutual of Omaha is probably fairly accurately priced today. Go ahead and offer the guarantees and show clients how they can get into something that's fully guaranteed and they don't need to worry about it. One last quick example with some older clients, just to show you that it works at various ages. Both of these clients are 65, so certainly on the older end, the numbers still work the exact same way. In this case, it is an extra $1,000 a year in order to get the guarantees, but I think it's totally worth it in order to get all of those extra values on the long-term care side.
And these guaranteed premiums, despite what happens to the costs?
The entire contract is 100% guaranteed, non-cancelable. Premiums can't be changed or altered. Benefits can't be changed or altered. And you get all of those backup benefits like I talked about.
This is a rudimentary question because you and I don't get too deeply into case with LTC, but is there the opportunity with LTC plans to kind of quick pay too? You fund early and then you can have years where you're scot-free?
My typical presentation style is I will show a traditional plan, I'll show a hybrid plan on an annual pay, and then I'll show them what the hybrid plan on like a 10 pay looks like. And if you're willing to have the premiums paid up in 10 years, if you can afford that extra pain cash flow wise, it's going to save you a significant amount of money in the long run. And I'd say the vast majority of people that are buying these types of plans are picking that 10 pay design.
Exposing yourself to a higher premium for, let's say, 10 years under a 10 pay plan, is that reflected in a better value on your cash values and death benefits?
Death benefit would be the same. Technically, cash value would be a little bit better, although this is not really a cash value driven product. The major advantage is, maybe you're paying, I don't know, all in, you're paying in this example, $11,000. If you pay those premiums to your age 85, that's 20 years. So you've paid in basically $220,000. If you did it as a 10 pay, maybe you're paying in a total of $150,000. So it's significant savings.
Worth looking at. Yeah.
I got a quick question, Matt, if you don't mind.
Sure.
When one of them goes on claim, are their premiums adjusted or are they still payable if only one of them goes on claim?
Good question. That's depends on the carrier. This nationwide plan that I'm showing right here, it does not have a waiver of premium. So I generally say it's going to be about a month and a half of benefits that will be allocated towards paying that premium. Is one way to think about it. So instead of receiving 12 months of cash benefit, you're going to receive maybe 10 and a half, 11 months.
Thank you.
I always state too, with Matt and with Ryan and with Tom as well, any of these things, we know we throw information at you. We're always willing to get with you and your client and their advisors on the phone. we don't expect you to have to reproduce what we're saying, accurately. We'll get on with you and spend time with you on either by regular conference call or Zoom call as well. So thank you, Matt. We
Absolutely.
don't get to see Ryan Mendoza too often here, but in the feedback, by the way, Lisa's monitoring a focus group here with regard to our return to the airwaves here. Both of you, Lisa has just texted me, got 4.5 out of 5 stars.
It's
The
true.
Ryan Mendoza, they said get somebody on the panel that can play golf. I don't even like to bring it up because I'm so poor at golf. You asked me the other day how well do I play? I said, well, I play in the 70s or 80s. If it gets any warmer than that, I don't even go outside. So, but Ryan, we appreciate you bringing your expertise to the table here. But Ryan, you and I have talked a lot in the past about the fact that people tend to treat the term marketplace as a commodity marketplace. They're all alike, run a spreadsheet, take the cheapest one and run with it. And of course, you and I know there's a lot of variables to look at over and above price that can affect things dramatically down the road. And you indicated you wanted to talk today about a particular term product that you have up front and recommend quite often for several reasons, and that's the Symetra SwiftTerm product. So please talk to us about that, Ryan.
Yeah, so first, thank you for having me, Tom. And anytime you want to golf, let me know and we'll go
All right.
golf. But
Keep the
yeah,
temperature down. So
yeah, we'll keep it between 70 and 80 there. But so yeah, today I would like to talk about Symetra SwiftTerm, and a few reasons why it's worked out really well for agents and clients is that one, it's fast, two, it's flexible, and then three, it's affordable. So first, it's fast. There's 3 different pathways a client can go down. The first is going to be instant decision. So if they go down instant decision, then it can be approved in as little as 18 minutes. Second pathway, it means the carrier might need a little bit more information, but that can be approved in as little as 1 to 3 business days. And then the last pathway is going to be full underwriting. So if the carrier needs to request a paramed to be completed, then it'll go down full underwriting, and that could take up to 30 business days to complete. And so that'll take care of fast. Flexible, it's flexible in its options. So it's going to be available for clients ages 20 to 60. And then it offers term durations of 10, 15, 20, and 30-year term. And then face amounts. It can go as little as 100,000 in face amount, and it can go as high as 5 million in face amount. And then one thing to note on that 5 million face amount, that could still possibly qualify for the instant decision process. So again, back to instant decision can be approved in as little as 18 minutes. And then affordability, clients want to make sure it's affordable. So, and it's been a main driver for this product. And as a result, it's been awarded by USA Today and Forbes as having best rates for term life insurance. So that remains to be a key factor for this product. So again, Symetra being fast, flexible, and affordable has been really successful for us in terms of the term insurance space.
I know, Ryan, you said if there's some underwriting issues, maybe the average is 30 days, but are we always cautionary with regard to saying if it gets into full underwriting, there's just no telling. How quickly do physicians respond, things of that sort. But
yeah, so it could take up to 30 days. It could take a longer depending on what they need. So whether it's medical records or whether the paramed is scheduled out past the 30 days, whatever it might be, there might be some areas where it extends it past that 30 days. But generally, let's say the client gets their paramed done, doctor's pretty responsive in getting the records back. I would say that 30
yeah,
days is what we try to stick to for this product.
yeah, getting back to the commodity mentality, because you and I deal with this all the time when you run the term spreadsheets. It's just, and so many times the top few are so close in price, but there's one in that pack that's so much better for some of the reasons you just described here. It's don't just pick the top of the list, you know.
Yeah, and I would say sometimes when you're looking at carriers, you're probably more buying a headache than you are buying a product.
Yeah,
So
yeah.
in terms of that, we definitely want to get with us, make sure that you're recommending the right product for the client and
Yeah.
that it'll be suitable for them. So
Yeah. I like this here. I have one recommendation, this fast, flexible, and affordable. I think you ought to change that just to flat, fast, flexible, affordable, keep
affordable.
keep the alliteration there. It works with reading, writing, arithmetic. I think it can work for your marketing idea here. So
The 3S.
yeah, thank you, Ryan. Lisa, do we
Hey,
have any
Ryan, what is the maximum issue age for
Max,
that
ma-
instant?
yeah, so age 60 is maximum issue age.
Thanks.
And it'll vary, so it'll depend on what term length they're going for. 30-year term will only be available up to age 55 for non-nicotine, or up to age 50 for nicotine users. But then 15, 20, and 10-year term will be available up to age 60.
Excellent. Thanks.
Good question. Just a general question, Ryan. If somebody is willing to look across the term marketplace, probably what's the oldest that people can get term coverage at, even if it's just 10-year?
Generally, it depends. It depends because they can typically go up to age 85 in terms of the maximum term duration. So let's say a client's 75, some carriers might be able to offer a 10-year term, but it varies by
Yeah.
carrier.
So when you say 85, that's a 75 for a 10-year term policy.
Exactly.
So, all right. Thank you. Lisa, we got any questions in the box there?
We don't have any questions, but we did have a good comment on the SwiftTerm business that for all SwiftTerm business handled in 2024, the average calendar days to formal approval was only 18 days. And
Wow.
that is half the average turnaround time for all life applications. So just a little addition there.
Fast,
That's
flexible, and
good.
portable.
Yeah.
Good stuff.
Gentlemen, thank you. Lisa, take us out of here.
All right, folks, thanks so much for joining us today. This presentation has been recorded in case you'd like to view it again. Please also take a look at it on our YouTube channel. And we appreciate you joining us today. And please be on the lookout for another invite, probably in a few weeks.
Bye, everyone.
Thank you, folks. Thank you, men. Thank you, Lisa.
Bye, everybody.